Johnson & Johnson are at their 52-week low at $155 a share. Is this the right time to buy this stock? Well, that is the question I am going to answer today. What we're going to be doing is looking at the financials of Johnson & Johnson, then taking it to my discounted free cash flow model and my Ben Graham stock valuation model to see if this stock is a buy or a sell in 2023. So firstly, let's just have a look at the stock price. As I said at the start of the video, it's $155 a share, down from its all-time highs at around about 186, down almost 10% over the last year. And if we take it back over the last 5 years, you can see this is a steady growing stock of about 16%. At the bottom of the pandemic, it was $120 a share, got almost up 50%, but is now up about 30% since then. If we compare this to the S&P 500 for the similar time, I would expect the S&P to have a much higher growth. Yes, you can see there 16 to 45%, but this stock is a staple for dividend investors. You can see here, once again, it is slightly lower than the S&P over this last year. But let's have a look at my stock valuation spreadsheet. So firstly, the market cap of JNJ is about $404 billion, share price of 155, and it pays a very nice dividend, 2.96%. And if you're interested in this dividend, buy the stock before the 26th of May, as that is the ex-dividend date. So let's get into it straight away. Firstly, we're looking at the PE ratio and is it less than the market? And the PE ratio is a ratio for valuing a company, and it measures the current price of the stock compared to its earnings per share. And the earnings per share are calculated through the company's profit divided by the shares outstanding, and this is an indicator to measure the company's profitability. P/E ratio of Johnson & Johnson is 23.1. If we just look at the average market here, this is the S&P 500 ratio, and this is the average currently of around about 21.65. So you can see J&J is a little bit higher than the current market. So that is the first step, and that is a fail. Next, we want to have a look at the revenue, and is the revenue increasing? Yes, it is. Over the last 4 years, it's gone from 82 billion to 94. Now, the revenue, this is money generated from normal business operations. It's the average price of the sales times by number of units, and it's a top line figure. And this is what we use to eventually calculate profit, where it's everything taken from this. So what has the revenue done? Well, it's gone pretty steady, 82 to 82.5, a big jump in the year prior to 93, and then has been a small increase again. But overall, it is increasing, which is what we like to see. Next, we want to have a look at the profit, and this is the net income. It's net earnings and it's sales minus goods sold and everything else. And you can see here they are a profitable company, and profits have been going up to 15 to just shy of 18 billion. Now, if we do look over the last 4 years, you can see it's gone from 15.1, 14.7 to an all-time high of just shy of 21, and now is back down to 18. So it is a slow growing company, as we can see, but still very, very profitable. Please give a like on the video if you're enjoying this, and subscribe if you're not already. Shares outstanding. Why do we care about shares outstanding? Well, this is the percentage of the company you would own. Say a company has 10 shares, you have 1 share, you would own 10% of the company. If they then bought back 5 shares, you would then increase your share of the profits to around 20%. And what are Johnson & Johnson doing with their shares? Well, you can see they are buying them back. It's gone from, it's quite a small change, but 2.632 billion down to 2.625 billion. Now, what is this an advantage for? Well, as I said before, they think their stock is potentially overvalued. They're buying them back, and they are rewarding shareholders for owning their stock. If they start issuing shares all over, then it dilutes the shareholders. But right now, they're rewarding shareholders by buying back the stocks and increasing the relative earnings per share on that. Finally, we want to look at the free cash flow. Is it increasing? No, it's not. Now, if we look at the numbers here, interestingly, 19.9, 20.2, 19.8, and then down to 17.1. So this is a down year. Overall, it has been increasing, relatively flat, but this is a negative right now. And why do we care about free cash flow? Well, that is cash from operations minus capital expenditures. It's the more free cash flow a company has, the more it can allocate to dividends, paying down debt, and growing. Now, we would like to see this increasing, but this is a fail as it is decreasing. So what does that give us overall? Well, it gives us 3 passes, as we said: revenue, profit, and shares, P ratio a little bit high, and free cash flow decreasing. But the margins are very fine on this. It was almost a 5 out of 5. So if we look at this as a free cash flow ratio based on the last year, it has a 23.5 free cash flow ratio. Easy for me to say, sorry, which is about the PE ratio. So let's take this to the discounted free cash flow model first. What we do here is it is a method of valuation which estimates the value of investment using the expected future cash flows. We take the value of today's investment, project the future cash flows, then bring it back to today, and this is how much money this company will generate in the future. So we've calculated the future free cash flows, discount them to today's value, and overall this gives us a calculated stock price currently of $157 a share, which means it's trading at about fair value. Now what we'll do is we'll have a look at the numbers here and see if there's anything really jumping out at us, but analysts are expecting that the revenue keeps on increasing at about 3% a year. If we look at the if we look at the revenue, it looks about steady growth rate as well, and the free cash flow ratio. So I'd say they're pretty fair estimates, and as you can see, it has got the stock about fairly valued. Now, if we look at the Graham's model, this is the formula that's used to value growth stocks. It was created by the father of investing himself, Ben Graham, and what this does, well, is it takes the company's value over the next 7 to 10 years. That is the number we're coming out with. Takes the earnings per share of the last 12 months, the P ratio, which has been revised down to 7. This is a P ratio of a non-growth company. We've got the growth of the 7 to 10 years of the earnings per share. This is a reasonable amount. The AAA bond yield, which is 4.4, and then we have the current bond yield here. If we look at the Moody's right now, we can see that the current bond yield is 4.57. Overall, this has been at its lowest point back in November and is now jumping up again to sort of really 2010 levels. So I put that number in here, 4.56. And then the expected growth rate here, this comes from what analysts are thinking, and they have it at around about 3.94% for the next 5 years. So what does this give us in terms of evaluation? Well, interestingly enough, it says the stock is pretty overvalued. $96 a share on the fair value, and then this gives us a Graham price of around about 72, which is a conservative estimate for the stock with quite a fair margin of safety. So both of the models, Graham's model saying it is overvalued, and the discounted free cash flow model is saying it is about fairly valued. Right, guys, thanks for watching. I'll be bringing out more of these style of videos, going back to my old way, reviewing a lot more companies. If you have any thoughts of which companies you want me to do, please leave a comment down below, and I'll catch you guys next time. Thanks for watching.